10 taxpayer rights you need to know. The passage of the Inflation Reduction Act signed into law by President Biden is expected to raise $737 billion in revenue. Of that amount, approximately $124 billion is expected to be derived from revenue enforcements. The IRS is expected to recruit an army of revenue agents in order to achieve this objective. As a result, taxpayers need to be aware of their rights and obligations. Other sources of revenue targeted by the Act are as follows: $222 billion from a 15% corporate minimum tax, $265 billion from prescription drug pricing reform, $74 billion from 1% stock buybacks fee, and $52 billion from loss limitation extension. The anticipated actions of the IRS makes it important that you know your rights as a taxpayer. Number 1. Taxpayers have the right to be informed. You have a right to receive clear explanations of the laws and IRS procedures affecting your tax obligations. Number 2. Taxpayers have the right to quality service. You have a right to receive prompt, courteous, and professional assistance when dealing with the IRS. You also have the right to speak with a supervisor if you are not satisfied with the service provided. Number 3. Taxpayers have the right to pay no more than the correct amount of tax. You are only required to pay the tax, interest, and any applicable penalties that is legally due. Furthermore, the IRS must properly apply any payments you have made. Any discrepancies may be challenged. Number 4. Taxpayers have the right to challenge the IRS's position and be heard. You may raise objections and provide additional documentation in response to formal IRS actions, or proposed actions, if you disagree with the assessment of IRS agents. Number 5. Taxpayers have the right to appeal an IRS decision in an independent forum. You have the right to a fair and impartial administrative appeal of most IRS decisions. Also, in most instances you can take your case to the courts if you are not satisfied with the response to your appeal. Number 6. Taxpayers have the right to finality. Audits cannot go on forever. You have the right to know when your audit will end and how much time you have to respond to an assessment. Number 7. Taxpayers have the right to privacy. Information request, including searches, must be carried out within the confines of the law, and must follow due process procedures. Number 8. Taxpayers have the right to confidentiality. Any information provided to the IRS should not be disclosed unless authorized by the taxpayer or by an appropriate law. Number 9. Taxpayers have the right to retain representation. You have the right to retain appropriate representation to handle your dealings with the IRS. You may also obtain assistance from a low-income taxpayer clinic if you are unable to afford to hire your own representation. Number 10. Taxpayers have the right to a fair and just tax system. The tax system is expected to examine the facts and circumstances affecting your tax liabilities, ability to pay, or ability to provide information timely. You may also obtain assistance from a taxpayer advocate service if you are having difficulties in your dealings with the IRS. Tax nexus and work-from-home employees. The increasing numbers of employees working from home as a result of the pandemic, and the current shift in trend towards remote working, needs to be evaluated to ensure compliance with state and local regulations. Many employers have acknowledged that there are clear benefits of a remote workforce. Cost-saving opportunities are available for fringe benefits that the company no longer needs to provide its employees. There is no need for daycare, parking, transportation, or other commuting costs incurred for employees working from home. Here are a few questions you need to answer pertaining to this issue. Number 1. Do you have employees working from home? Number 2. Do you have a policy in place that addresses tax nexus issues? Number 3. Do you know in which state your employees reside? Number 4. Are you in compliance with applicable state filing requirements? Number 5. Have you forfeited the protection of Public Law 86-272? Would you like to be kept informed on issues like this in future? If so, please subscribe and leave a comment to let us know what topics interest you. So, what are the normal rules applying to where employees reside? In general, you are considered to be doing business in a state where you have employees working. As a result, you will be subject to state tax laws and other local laws. Normally, employees living in a different state doesn't create tax nexus. However, remote workers might attribute presence to the companies they work for. Nexus may be created when your employees work in a different state that is not your usual state of operations. Note there are other situations that may create nexus footprint in a state. So, what is the relevance of nexus? Businesses are required to register and pay applicable taxes, new income and franchise tax, sales and use tax, and in some states payroll taxes. In states they are considered to be doing business. You may be considered to be doing business in states where you have employees working from home. If your remote workers create a nexus footprint in a state other than your registered state, your company may now have new registration and other compliance obligations in that state. Due to the creation of a nexus footprint in a new tax jurisdiction, you may have significantly different apportionment factors for income tax purposes. Businesses selling taxable goods or services may need to start charging and remitting sales taxes in the new jurisdictions. Another consideration for business with remote workers is that, a business with established nexus in a state, may have been protected from state income tax by Public Law 86-272 because their activities met certain exclusion requirements. However, the existence of a remote employee may result in new tax exposure due to the loss of Public Law 86-272 protections. The public law protection in question is a federal safe harbor preventing states from taxing net income, the business activity of companies, whose operations within a state, is limited to solicitation of orders for selling tangible personal property. This video contains general legal information, it does not offer legal advice. For legal advice, please consult your attorneys. For additional resources, check the links in our bio. In this video we will look at the 7 reasons we like real estate investments. Number 1. Mortgage paydown. Having tenants pay down your mortgage is one of the biggest benefits of real estate investing. Each payment contributes a greater principal reduction from your mortgage loan balance. Principal reduction equals equity for the investor. Number 2. Investors receive favorable tax treatment. Some of the benefits include capital gains treatment when you sell your property for more than you paid for it. Also, when you sell your primary residence, you can exclude qualified gains up to $250,000, if single, or $500,000, if married filing jointly. You can also defer tax payment on investment property sold if you meet certain qualifying conditions. Number 3. Leverage. Financial institutions will lend you up to 80% of the amount you need to purchase an investment property. This means you can make massive gains in your wealth with only a 20% investment. Real estate is one of the best ways to use other people's money to build wealth. You can use the bank's money to buy the asset and the tenants pay the bank. Number 4. Appreciation. This is the increase in value of real estate over time. There are a number of factors that contribute to this increase in value. These include housing supply and housing demand, improvements to the property, changes in interest rate, future development plans, etc. Number 5. Tax deduction. Owning rental property is similar to operating a business. You are allowed to make tax deductions for expenses incurred in generating your rental income. Also, some losses from your rental business can be used to reduce your other income when filing your personal returns. Number 6. Opportunity to split income. Investing in real estate offers you an opportunity to employ your family members in the business. You can shift income to members of your family who are in a lower tax bracket to reduce your overall tax bill. Number 7. Cash flow. This is the ultimate goal of real estate investing. Investors should pay close attention to this metric. All real estate investment should be cash flow positive. Over time, as you pay off your mortgage, you can use the cash generated from your investments to fund your retirement. For our practical guide on how to get started building wealth through real estate, see the link in our bio. In this video we will look at the difference between cash flow and profit. So, what is cash flow? Cash flow is the sum of all movement of cash in and out of a business during any given period. It can be positive or negative. Positive cash flow increases your bank balance. Negative cash flow increases your debt or forces your business to stop operating. Positive cash flow is an indicator of a healthy business. Investors love businesses with healthy positive cash flow. Cash flow is not the same as profit. So, what is profit? Profit tracks the difference between the income generated by a business and the expenses and obligations it incurs in generating that income. It is important to note that, not all expenses and obligations impact cash flow in the same period. For example, if you finance the purchase of a car for your business, the obligation for the loan may extend over more than 1 year depending on the term of your loan. If the loan term extends for 3 years, the cash flow for those payments will be spread over 3 years. In addition, not all income earned are collected in the same period. In order to boost sales, many companies offer net 30 or net 60 credit terms to their customers. According to these terms, a customer will have a 30-day or 60-day grace period before paying for the goods they bought from the business. There may also be other situations where a customer may not be able to pay for goods in the same period of the sale. Because of these timing differences, businesses need to implement a system of cash flow management. It is important that a company monitors the movement of all cash moving through the business for several reasons. Cash flow is the lifeblood of any business. It is like oxygen to the human body. Since cash flow is the lifeblood of the business, a positive cash flow is a sign of a healthy business. Investors will have more confidence in extending credit to a business with a healthy positive cash flow. Personal finance tip: cash flow is one of the most important metric in deciding on any investment. There are a number of benefits to monitoring cash flow for your business. Monitoring cash flow helps reduce stress as you have a clear picture of the health of your business. You can identify shortfall in your cash and adjust your operations accordingly. Another benefit from monitoring your cash flow is that it can help to boost the growth of your business. Cash flow monitoring allows you to leverage extra cash generated by your business to finance further growth. Additionally, a strong cash management process helps a business in making better financial decisions. In this video we will look at 10 important steps in starting a business. Creating a new business requires careful planning and execution. There are a number of financial and legal activities that needs to be completed before getting started. The process can be daunting if you have never done it before. Here is a checklist of the core activities that need completing before you open for business. One. Determine the name and business structure. The name you choose for your business should be easily searchable. Ensure you factor the Google search engine optimization (SEO) in deciding on a name for your business. Also, If possible, the name should relate to the nature of your business to assist potential customers in finding you. Decide on a suitable structure for your business. Choose from 5 different structures: sole proprietorship, partnership, limited liability company, LLC, S corporation, and corporation. Once you have a suitable name, you need to protect it by registering it with state and federal government. 2. Develop your business plan. Developing a business plan is an essential step in starting a business. This is a tool that will assist you in obtaining outside funding for your new company. Investors and financial institutions will evaluate the viability of your business outlined in the plan. So it is essential that your business plan is properly prepared. At minimum, your plan should address the following: vision for the business, funding sources, how long will you be able to operate using your own funds, marketing plan, sales channels, etc. It is essential that you critically assess the viability of the business plan you have created. 3. Review the business plan with an accountant. After you have assessed the plan you created, and you are confident it is a solid plan, it is time to have an accountant evaluate its viability. An accountant can assist you in developing a suitable pitch for outside investors and financial institutions. This is very important if you require substantial financing from external sources. 4. Apply for Federal Employer Identification Number. You can obtain your Business Federal Employer Identification Number, FEIN, or EIN, for free from the IRS through their website. You will need an EIN in order to open a business bank account, process company payroll, pay payroll taxes, and comply with income tax obligations. 5. Create a business bank account. Access and convenience will be key in deciding where you open a business bank account. You may be able to open one with your current financial institution. Alternately, you may shop for one with a local bank or credit union offering suitable terms for your business. Personal finance tip. Considerations, such as access to financing and establishing business credit, are important factors to be included in your evaluation. 6. Choose and lease a location. Choosing the right location is also an important step in starting a new business. Having an appropriate space for your new business is essential. Whether you are planning a retail or service business, working with a realtor may be helpful in getting a suitable location. They can assist you in finding properties that are zoned for the type of business you plan to operate. 7. Obtain necessary permits and licenses. The type of permits or license you will require will be determined by the nature of your business. Some types of business will need licenses and permits on the federal, state, and local levels. Consult with an attorney if you are unsure of the licensing requirements for your business. 8. Set up company bookkeeping. Get organized before things get hectic. Get outside help with keeping track of income, expenses, and cash flow management. Hiring a freelance bookkeeper is an excellent way to free up your time so you can the business. 9. Acquire business insurance. Obtaining business insurance is a good idea. It is also essential in obtaining certain contracts. In addition, business insurance offers protection for your business and your assets. 10. Open your business for customers. You should have already addressed the sales channels in your business plan. How will you be promoting your business? Establish a presence on Google. Include your business address and opening hours. Consider a pre-launch advertising campaign to let everyone know about your store opening. Include any other ad campaign as appropriate. This step should be carried out as part of your overall business plan. Ensure that you are executing in alignment with your overall marketing strategy. Does your LLC meet the foreign qualification requirement? If so, its legal standing may be in question if all the required steps are not taken. So, what is the foreign qualification requirement? Your LLC is considered domestic in the state it was formed, and foreign in any other state it carries on a business. So, how is the foreign business classification determined? Here are 2 tests to help you determine if you are doing business in a foreign state. Number 1. The physical presence test. Do you have an office, store, or warehouse that services or solicits residents of that state? If so, you meet the physical presence requirement. For example, you may have sales representatives, or you may have established a credit union account in a state, in order to take advantage of certain benefits available to residents of that state. You may inadvertently be considered as doing business in that state as a result. The second test is based on where you have to pay state taxes. If you are paying state taxes in a state, you will most likely be considered as doing business in that state. If you are considered as doing business in a state, you will need to obtain a certificate of authority. A certificate of authority issued by a state ensures your business maintains legal standing, or authority to carry on business in that state. A foreign certificate of authority grants you permission to conduct business in a foreign state. A foreign state for this purpose is a state other than the one in which you registered your LLC. Failure to obtain an official certificate of authority will result in the loss of legal standing or authority to carry on business within that state. The rules on what is considered transacting business varies from state to state. As a result, ensure that you are familiar with the state requirements for each state in which you operate your business. Failure to comply may affect your business's certificate of good standing required to obtain business financing, renew your business license, or file your business taxes. What are the required steps in the foreign qualification process? The steps are similar to those you follow when you first registered your business. However, you will need to pay attention to individual states' foreign qualification requirements. The steps are as follows. 1. Perform a name search in each state. If the name you are using is already taken, you may have to operate under an assumed name. 2. A registered agent is required for each state in which you conduct business. 3. You need to obtain a certificate of authority, granting you permission to do business in the state. As mentioned before, state requirements must be followed. For example, in Florida, foreign LLCs must submit certificate of existence, no more than 90 days old. The name of the LLC must be distinguishable on the records of the Florida Department of State, and must contain the words Limited Liability Company, the abbreviation LLC, or the designation LLC. For additional resources, check the links in our bio. This video contains general legal information. It does not contain legal advice. Please consult your lawyer for legal advice. Thanks for watching. Six reasons to file an amended tax return.